You're letting people in, right? Yep. Let's see it coming
I'm
in.
joining. Hello everyone. I think people are joining. Zach, could you please also rename yourself, like instead of H4XF's team?
Yes.
See that Alan is texting. Give another minute for folks to join us. I think we can start and people will join us. So hello everyone. And I am the moderator and my name is Sardar and I'm from H4XFs. And it's a pleasure to have all you here with us today. And we have the privilege of hearing from two distinguished speakers who will share their insights from different perspectives. And Kenji is with us today, partner at Wilson Sonsini, which is one of the most reputable law firms here in the Bay Area, here in the Silicon Valley. And he will provide some valuable legal perspectives. And while Chris, an investor from Paperjet Ventures, and he will offer his insights from an investor's standpoint. And following these insightful discussions, we will have a 10-minute Q&A session. And for the last 5 minutes, I'd like to see closing thoughts from our presenters. And for the Q&A session, Zach is going to help with the Q&A session. Do you want to add something to that, Zach? Any explanation?
Feel free to throw in your questions in the Q&A section in the bottom. I'm going to be moderating it and kind of giving it over to Sardar. But yeah, feel free to ask the questions as they come, and we'll be sure to incorporate them.
Thank you so much. So I'd like to start with Chris. Could you please introduce yourself and give us a glimpse into the trends and perspectives that you will be sharing with us today?
Sure. Thanks for having me. Awesome opportunity to share some of the insights I've seen in the market. So I'm Chris, based in the Bay Area Mountain Views. Specifically, I'm active early stage investors, as you mentioned, at Paperjet Ventures. We basically invest in founders with bold and disruptive ideas at the earliest stage. Our main focus is mostly deep tech, electrification in space, and AI and ML. So I'm kind of, being all over the place, I've been a product manager and a founder over 10 years, primarily in the Valley and New York. Also have a background in Wall Street, but currently, I'm actively looking for the next great founders, the next NVIDIA, the next Tesla. So, from pre-seed investing to I also mentor and advise the university teams like MIT and Cornell, and also work with Ellen with research and DDE. Looking up from some of the deals on her network. In terms of where we are today, do we have slides that we can share a little bit?
Yes.
I can talk a little bit on the high level and then give you some additional details.
Perfect. Let me just pull them up. Wait 1 second. Where? These are, sorry, Chris, I'm just presenting these.
Yeah.
Can you see my screen?
Yeah.
Yep.
Perfect.
So if you go, this is my, LinkedIn and Twitter and Substack, which I can share later also, but let's go to the second slide. So I basically, when I started angel investing a few years back, I came from the bull market era, where there was tons of deals, volume, liquidity, was enormous. As you can see, coming, away from the zero interest era, in terms of volume and valuation has dropped quite a bit, especially in the last 12, 18 months, even though it starts stabilized in the last quarter. But for the most part, if you look at and this data comes from Carta directly, so they have pretty good, research, because a lot of companies put their, the deals on the platform. So they have pretty good insights in terms of where, like, some of the key metrics are, such as valuation. So if you look at this chart, you can see that the average cap, has dropped, from $15 million post money to 10, but it's all over the place, and I include this in specifically pre-seed and seed. The exception is AI. So in the AI deals, if you look at the recent batch, with the popularity of ChatGPT and other generative AI, in the news cycle, some of the deals that we have seen, can go as high as $25 million post money with some traction. But generally speaking, for anything under, for most of the companies, if you look at the next slides, you can see the trend, can you go to the next slide, Zach?
Sure.
Yeah, you can see, how it trends basically, 15 to 10 for early stage, was pre-seed and seed round, but anything under the $500,000, the cap is around 6.5. And if you look at on the sector breakdown on the next slide, you can tell, some of the sectors, definitely has dropped quite a bit. Zach, on the next slide.
Sorry.
Yeah. So especially fintech, SaaS has dropped quite a bit as well, and the most of the deals in there. And it really depends, on, if you go to the next slide. So for the most part, it's around, at the median is around 8 to 10. Some of the more asset heavy companies, especially in hardware, they tend to command a higher valuation. But this sort of gives you some idea in terms of where we are today in the marketplace.
I mean, there's a clearly decline in most of the sectors. Some of the sectors decline more than the others.
Yes.
But what about the stage level thing? Like, can we say early stage companies more affected from the decline when we compare to the more mature companies like Series A, Series B, and so on and so forth? Or there's no any correlation between the stage of the companies? And I also like to ask this thing to Kenji as well, because as I have said, like, he's one of the most reputable companies, and they do handle a lot of deals in this area. So I'd like to get also your insight, Kenji.
Yeah, go ahead, Kenji. Yeah.
Oh, please. I was just going to defer to you, Chris, in terms of
Yeah.
I would say, in the beginning, where as the market revert from zero interest rate, the higher the companies that is most that's more sensitive tend to be in later stage and mid stage, because of the presence of non-traditional funds, such as the crossover funds like the Tiger Management, that have inflated the market quite a bit. At the same time, the IPO activities, if you look at the next slide, has really trailed off. And so there's a lot of money kind of parked in the late stage, companies, but there's no exit horizon that can, provide liquidity back to the marketplace. So late stage, mid stage tends to suffer first, and then some of the funds that are actively investing, they start to move back to seed round and pre-seed. It's in some examples, and so they but at some point, the longer we continue in the high interest rate environment, even the seed round gets affected, but they tend to be less incentive compared to like the later stage.
Yeah, I'd agree with Chris's observations. I think that it's important to note that the VC environment and the capital markets environment for that, to that point, let's say 2020 to 22 was really an anomaly and the exception to the rule. And so what we're seeing in 2023 is really a normalization to kind of historical norms. And, the process by which that occurs can be quite jarring, particularly in light of the frenzy that occurred in post-COVID, immediately after COVID. And as a result, there's effectively a trickle-down effect, as Chris had mentioned, where the public markets are the first to reprice because they're liquid. Then the pre-IPO or crossover rounds, sensing that the capital markets IPO windows may be closing, then we consider deploying capital. And then at the early stages, we don't see valuations be as sensitive perhaps at the later stages, but it's just a continuous repricing cycle that has a trickle-down effect. And I think furthermore at the early stage, we're probably seeing less deals get through, but at roughly equivalent valuations to what we've seen historically. And I think that's a function in part by two variables. The first of which is there's less capital deployed at the early stage, and then number two is that from an investor perspective, the length of time by which they are expecting return is longer than, let's say, a pre-IPO investor.
Serdar, we got a question in from the audience. Wasn't necessarily about early stage or late stage, but it was from Chris Torrey. I hope I'm pronouncing your name correctly. And it said, the IRS notice says that the IRS, quote, intends to issue proposed regulations. Does that mean a small startup venture has to capitalize back to 22, or can it start next year, or when? Chris or Kenji, if either of you want to take that, or both.
Yeah, I'm going to defer to you since it's more regulation related.
I'm certainly not a tax lawyer or tax accountant, so we would need more specifics on that, but happy to address that offline or separately.
Kenji, I mean, you have mentioned like the early stage deals are down, but I assume like there are still some deals are going on. What are the common points of the startups that are still fundraising? Is there any commonalities that you can point it out still in this environment?
Yeah, and I'd love to get each of your thoughts as well as Chris's input as well. But it's some of the same elements that we've seen traditionally with companies that get funded in either a robust funding environment or a not so robust funding environment. I think first and foremost is the team. And I think that if it's a single founder with a very grand vision that will require a significant team to surround him or her, oftentimes at the early stages, investors will want to have a better sense of exactly how that founder intends to build the team. Particularly if that founder is working another job, for example, or is not dedicating 100% of the founder's time to the venture. I think the second is, the status of technology development. Certainly investors would love to try to de-risk technology development to the greatest extent possible. I think that it becomes more challenging in deep tech because the capital expenditures are significantly higher. So, unlike software where an MVP can be established with, a small group of coders, I think with deep tech, it's a heavier lift to be able to accomplish an MVP. I think the third is then, product market fit by way of customer validation. And again, that can be a heavier lift as well in deep tech, given that the customers can be quite large enterprises and just finding the right contact people within those enterprises can be challenging, but that's certainly a positive signal. And then, I think also, getting non-dilutive funding by virtue of grants or some kind of validation, external validation, whether it's through grants or whether it's through scientific papers, whether it's through a beta test from a potential customer. All of these are helpful, supporting points to this issue of product market fit and the ability to give comfort to the investor that they're backing the right team and they're backing the right technology.
I can add additional color to what Kenji said. I pretty much agree with the whole sentiment, right? Because when I started investing, it was during the bull market where you can pretty much, because there's so much money in the system, you can pretty much raise just based on ideas alone or chasing like a mega trends like Web3, if anybody still remember that. But the requirement has changed right now, in this current environment. Investors demanding to see companies demonstrate their ability to get to revenue faster. So if you look at the recent YC summer batch, there's a trend where majority of B2B companies had paid customers. They want to see how fast can you get some traction to de-risk your execution ability. They want to see recurring revenue. They also want to see companies that have ability to get contracts from large companies that normally they are too big to work with small startup company. So by demonstrating that, I think it's definitely where in this environment you have ability to separate out what are the stronger teams that are able to execute compared to the ones that just mostly hoping to raise money based on ideas alone. Zach, you're on mute.
Sorry, Chris, I'm not sure if we saw your last slide.
Yeah. So I was going to mention that, while the trend, it looks like the valuation and all the deal volumes is slowing down, but, there are a couple of things I want to point out. I'm sure a lot of folks, been following the IPO market. So some of the key deals that I think, could really change the narrative, right? With the recent IPO deals. We have Instacart being priced, this year, and Klaviyo. Those are the two venture-backed companies, and so the IPO market has been, as you look at this chart, right, has been kind of mostly dead for the last 18 months. Because of that, bankers are trying to price the deals and made the pricing really attractive to bring investors back to the marketplace, and this could at least open up more liquidity into the system. But the deals that was done, for instance, the Instacart, it was priced at what, $30 a share, which is $10 billion valuation. That's still pretty, while it's pretty successful, but it's still pretty steep coming from last private round of $39 billion in raise. If you look at the multiple, it's around 4 to 5 times, which is equivalent to some of the comparables like DoorDash. But it's definitely far away from during the zero interest rate, when companies were able to raise like 25 times multiple. But I think this is healthy. This kind of allows some of the late stage companies to have liquidity and exit. I'm also starting to see like some of the late stage deals being offered to investors like Stripe. In anticipation there will be IPO possibility in the for remaining of this year and spring of next year.
Good. Thanks so much. So Benji, would you like to lay out the fundamentals of the legal aspects of fundraising? Maybe.
Yeah, happy to do so.
Kenji, I'll pull up your slides.
Great, thanks so much.
Wait 1 second.
I think maybe as we're pulling up the slides, another corollary, kind of reference point to the IPO market is also the M&A market as well. And I think that, by and large, most companies that are venture track or that raise financing in anticipation of an IPO will ultimately get acquired as opposed to go into the public markets. And so as we start to see strategics become more acquisitive again, I think that also catalyzes the earlier stage funding environment. And it's interesting in the area of deep tech, for example, or defense tech, in the sense that with many of the companies that we work with, and that the collective group here may work with, the companies effectively bootstrapped off of either government contracts or grants or some combination thereof, and that's oftentimes a good validation point for investors that see that there's effectively a significant customer in the form of DoD or some other agency for their products. I think as startups that maybe start on a time and materials basis for government contracts or other types of contracts start to explore the possibility of venture financing, I think it's one topic of discussion that arises is the ability to create a scalable product or service that may not necessarily depend on the services component of revenue to a certain extent. And so one thing to consider for those deep tech entrepreneurs that are on this call is to the extent that you're getting good traction through kind of service contracts or time and material contracts, particularly whether it be from government or non-government actors, but are starting to look towards venture financing as an alternative financing option. The ability to scale the business quickly and to automate the business to the point where you can create a recurring revenue model, as Chris mentioned, like in the context of software or in the context of a repeatable revenue model, I think will be very important. And some companies have, or some companies and/or technologies are just inherently built to be able to scale quickly. Others, I think, it's just a heavier lift from the standpoint of validation, customer onboarding, technological development, and so forth. So, as each of you start to enter into discussions with investors, just anticipate that venture is typically a fast growth business model where capital is injected in installments to facilitate rapid expansion of the business and specifically the revenue. And so looking at your core technology, looking at your team, looking at your customers, your customer concentration, and how your revenue is constituted, I think will be helpful because with the endpoint in mind of whether it be an IPO or an M&A, being able to scale quickly with the capital that and deploying capital efficiently, I think it will be a very helpful data point to come armed with as you initiate discussions or continue discussions with investors. I think segueing over to perhaps a high level overview of the legal considerations. As Chris noted, the funding environment is not where it was, in the post-COVID era, and so as a result, investors in general are becoming more discerning in terms of their investments. Some of them may be looking towards funding their existing portfolio investments as opposed to deploying capital into new companies. And so, to the extent that you have engaged in discussions with venture capitalists, private equity, or other funding sources, and you have had success in kind of getting them excited about your technology, your company, or your product, and it advances to the point where the investors have put together a term sheet, or the company has put together a term sheet, and there's a meeting of minds on valuation and some of the other bells and whistles that come with an investment. The company and the investor will generally come to either a binding or non-binding term sheet that details the scope of the investment and the nature of the investment, whether it's early stage in the context of, let's say, a safe financing or convertible note financing, or potentially a priced round, as you see in Series A and Series C, all the way to Series F and Series G. At that time that the term sheet is finalized, or in connection with the finalization of the term sheet, the company also may receive what's called the due diligence request generated by the investor's lawyers. And that will be a 5 to 6 page document, basically asking for what's called access to a data room. And that data room is effectively a document production of some key agreements, some key charter documents, and other material documents that relate to the company's operations. And given the environment where getting an investor's interest is really critical, maintaining an investor's interest is also very helpful as well. And so sometimes it's helpful to even before the term sheet phase, even and certainly before the opening of the data room, to give a couple of consideration, give some thought to how your data room would look like if you were to turn on the switch right now. And are there things that you can proactively manage before the investor or their counsel flag the issue as part of their ongoing due diligence into the company? Because at the end of the day, from a company perspective, companies don't want to give investors a reason to say no, particularly in the context of due diligence. And from the investor's perspective, the investors want to ideally see a data room where the company has and its management and its board have already thought about some of the considerations that can become holdups from a legal perspective to closing the deal. Specifically, this slide is not a comprehensive list, but just some of the items that a company that is seeking financing may want to look at and kick the tires on before doing a deep dive with an investor, and certainly before the investor itself starts to conduct due diligence. The first of which may seem self-evident, but is critical, which is really finalizing the capitalization of the company. And that relates to not only the ownership by the founders, who are there typically from day one, and whether those founders' shares have been memorialized in board consent, whether there has been adequate consideration paid for the shares, and specifically in the context of venture track companies, whether those shares are subject to vesting. VCs and other investors will typically look for anywhere between a 3 to 4 year vesting schedule for founders who receive what's called restricted stock, meaning that they have stock from day one. They can vote that stock, but should they leave, then any unvested portion of their shares could be repurchased by the company, and thereby, decreasing the amount of float in the capitalization of the company. The rationale for that is, let's just say you have 3 or 4 or 5 founders. One of them, decides to leave the enterprise, before really the enterprise has gotten going, and now you have a founder, an ex-founder who has the same number of shares as the active founders. The VC looks at the cap table and goes, wait a second, there's some dead weight on the cap table. What has this founder actually done historically, and because they're not really doing anything going forward. A vesting structure or a restricted stock structure helps facilitate the company's ability to repurchase those shares by, again, imposing what's called a vesting schedule, where like you'll hear these terms like a 3 or 4 year vesting schedule with a 1 year cliff, meaning that 100% of the shares during the first year of the company's formation or services provided by the individual may be repurchased if that individual leaves or is terminated before the first anniversary of his or her employment or the founding of the company. And then there's typically like monthly vesting thereafter on an installment basis for the duration of the 3 or 4 year term. That actually is a very helpful tool for those in a multi-founder environment or for those seeking venture financing, because the absence of that makes it quite difficult to claw back shares that are already held by a founder or a co-founder. And it just makes things a little bit more complicated should they start engaging in VC discussions, particularly for an ex-founder that has a good chunk of shares, but there's no clawback mechanism. Capitalization also, I think, should be thought of in the context of doing your SAFE round or doing your convertible note round, because while they don't show up immediately on your cap table, one thing to avoid is to, for example, raise a bunch of SAFEs or simple agreements for future equity that convert at a low valuation, and then you keep stacking them over 1 or 2 or 3 years before a price round. And then they convert in the price round, and the founders realize that they've taken on much more dilution than they expected. So having a capitalization structure and a capitalization, what's called a cap table, that kind of maps out both existing shares as well as future obligations to issue shares, be it through SAFEs, convertible notes, and stock options, I think will be helpful just to give both the founders and the board and the investors a snapshot of what ownership is going to look like. Similarly, with respect to founders, boards, officers, employees, and consultants, a corporation is a legal entity, and as such, it, in order for it to maintain its limited liability shield, it has to have a certain, process and formality to it. And so, the stockholders generally are you have the founders receive the bulk of the shares at inception of the company. The founders may adopt a stock option pool. Those stock options are given to, employees and consultants, after the formation of the company. Those options are not voting until such time that the optionee has vested options and they can exercise them for shares and then become a shareholder like everyone else. And then the stockholders then appoint the board. The board then appoints the officers, the chief executive officer, the treasurer, and the secretary. And the officers and/or the board will then engage employees and consultants to do the day-to-day work. And so just having paper relating to the memorialization of who are the board members, who are the officers, are there offer letters for employees, are there consulting agreements in place? Those help reinforce the legal, the legal paperwork associated with onboarding these individuals, and will have very important provisions such as the third bullet point, like who actually owns and the intellectual property. And so generally speaking, on the inception of a company, the founders buy their shares for some nominal price, and they'll also assign the business plan and maybe some pre-existing IP relating to the particular business to the company. And then going forward, both the founders, the employees, and consultants will sign documents, whether they're confidential information and invention assignment agreements, or whether they're consulting agreements that have similar provisions saying, hey, for everything that we develop on behalf of the company going forward, the company will own the underlying intellectual property. And these are one of like the key foundational documents for deep tech companies and companies that are reliant upon intellectual property and trade secrets to have in place. Because one thing that will give an investor some pause is if there was a ex-founder or an ex-employee who was an engineer and developed some pretty important components of the product or the technology, and they didn't sign an invention assignment agreement. And now that ex-employee or ex-founder has a significant amount of leverage before there's any motivation to sign something over to the company of their pre-existing IP. So, it's always best to put these in place at the beginning of the relationship with respect to these individuals, and then later. Using third-party intellectual property and co-developing IP is a similar thing to think about in the context of deep tech companies and other companies as well. Oftentimes, there might be third-party technology that your companies will need to be able to commercialize their core technology, and ensuring that there's some kind of paperwork, from the owner of that intellectual property where your company has an exclusive or non-exclusive license, and the economics of that license are clearly defined, would be helpful. Because if it's a core piece of technology and the licensor terminates it, that could be adverse to your company. Similarly with co-developing IP, oftentimes with bootstrapping companies, there's a desire to work with other companies to jointly develop technology, or potentially to work with the government, or to work with agencies to jointly develop intellectual property or jointly develop a particular project. One thing to note, and I'd reference this time and materials, kind of contract structure earlier. One thing that, particularly if your company has intellectual property or trade secrets that they want to maintain and believe it has value if the company continues to own 100% of, is seeing the fine print in a master services agreement or a consulting agreement where the company is a consultant to a customer. and ensuring who actually owns any novel IP that arises from the relationship, because there is a risk potentially that your customer, depending upon the drafting of the agreement, may own that intellectual property that your company develops for them, and that you wish to use for other customers going forward. So, one of those key provisions in a MSA, consulting agreement, or other customer contract is really delineating who owns what. What IP does each party bring to the table? What new IP will be created as a part of that relationship, and who owns it? Because that will come up in due diligence as well. Customers, I think is self-evident. I mean, certainly, there are a number of companies that will try to work with customers on a handshake deal or a beta deal. As the company starts to grow and achieve revenue, as Chris had mentioned, it's important to have a contract in place that actually delineates the obligations of the parties and the resulting, revenues to be paid, because that's what, investors will look at when they start to extrapolate value, forward value of the company. And that's true on the vendor, supplier, reseller, and distributor side as well. Just all of the channel partners associated with your company. Generally speaking, they'll need to be some paper in place, particularly if they're material, or maybe you're relying on a single supplier for a key piece of technology. You want to maintain not only a good contract that confirms that you'll have continued access to that supply, but even as a non-legal or business matter, you'll want to consider not being overly reliant upon a single supplier to the extent that that supplier either cancels a contract or goes out of business.
Thanks. So I do have a question, actually. At this point, when it comes to legal, there are too many elements and too many details. My question is, like, how has these elements changed, and are investors taking more time to do due diligence and checking all of these items? Maybe Chris also can answer to this question as well as a follow-up from the investor's perspective. But
yeah, I'll be happy to share some perspective. I would say that that when there's a lot of capital in the system, right, there tends to be a bidding war amongst investors for companies that are popular, and in that bidding war, companies will be in a position where it's effectively a seller's market, where they can set the terms of the financing, and they can also set the timeline for the financing, because they'll say, well, if you, investor A, don't do this deal, then I've got another term sheet from investor B, and so I'll give you like a week or two to close it up. What that does is it creates time compression for the investor's lawyers as well, to try to identify some of these red flag issues. And at times investors will say, look, we just think that the company is so strong and that there's so much competition for this deal that we'll do less due diligence than before. I think in today's environment, though, you don't have as much of a bidding war, so to speak, over deals anymore. And oftentimes, or more often than before, it's just a single VC or a single investor engaging in a discussion with the company regarding a potential investment. And that investor, it's now a buyer's market where the investor can take their time, really get to know the company, really have their lawyers check the box on any potential legal issues that may arise, that could be a red flag or a showstopper. And so I think because of this time compression element associated with deals when the markets are flush with capital, because that isn't necessarily present in all aspects of the industry anymore, I think these legal points become more relevant, because investors just generally become more cautious and they have more time to conduct diligence.
I can provide from an investor's point of view, because I've been helping some portfolio companies in terms of preparing for the price round. I would say, echo a couple of points that Kenji mentioned, right? The two things, if you're not in a competitive market where it's a buyer's market, the two things that you have to manage proactively is it takes much longer to close the deal. So you need to figure out a way to streamline the due diligence process. So the data room that on this slide is really helpful, but I would also say, create like a Notion doc so they can highlight some of the key points And then include, in terms of like financial projections, you really want to make the assumption page really strong to guide the investors what to look for. And in terms of what to look for, it should be kind of, you should control the narrative, right? So for example, if the market right now has changed from hyperscale growth at all costs to efficient growth, then point it out to investors in terms of how you're running the company, like what are the key things like the burn rate, your runway, some of the key milestones that you have set with the fundraising that you have. What's the path towards cash flow positive, or if cost is an issue, what are the measures you're taking to control the cost? Then also on the revenue side, again, talk about what are some of the big contracts that you have in the company from like large enterprise company. What are the use case? And give additional color beyond just like the size of the contract, as opposed to putting all in there, or be prepared to ask like some of the questions if you have contract with a bunch of small companies that are more sensitive to the high interest environment. How do you proactively manage those relationships or dedicate your resource, because of the possible risk of churn, for instance?
I think so. So basically, be ready for the follow-up questions.
Yeah, be ready for them, but also proactively manage them. Create it, if there's, create like FAQ, basically, so that investors can go actively look for that rather than going through the entire data room and try to come up with their own assumptions on key risks of the company.
Thanks so much. So, Benji, as I said, like legal is kind of hard to manage just by yourself as a founder. When is the best time to work with a lawyer as a founder during the fundraising process?
Yeah, I would say, from day one, because, building a company from a legal perspective is kind of like building a house. And so, you want to really have a good foundation. I think that, we'll get in early. We'll get in at the incorporation level to kind of work with founders in terms of, what the capitalization, how that's going to be structured amongst the co-founders and so forth. And so, I think starting from day one is helpful, because that actually then mitigates the back end time necessary to either review or fix items that may occur, on the eve of the financing if these issues haven't been thought through. And so, I think it's an ongoing process. I mean, certainly, companies can if there's no showstopper issue, something that would really cause an investor to walk away, many of these items can be fixed or remedied or explained proactively, as Chris had mentioned. But it's just a function of minimizing surprise to the investor, and then also, just it's kind of like this ounce of prevention concept of being able to proactively manage on the legal side, and also the business side, as Chris mentioned, relative to revenue relative to cost of goods sold and so forth. And I think maybe that's the takeaway with respect to the rest of this slide, is that just anticipating some of these questions that an investor or their counsel may ask on the front end will be very helpful, because startups move quickly, and they often are a very lean team. But the thoughtfulness of the founders of seeing around the corners and so forth, I think will be a positive signal to investors during the diligence process and thereafter.
Thank you so much. So actually, I would like to leave the last 10 minutes to the questions from our audience. So please add your questions to the chat section. Any questions, Zach? Do we have any questions so far? Oh, you're muted, I think.
I have not seen any questions yet.
Okay.
To all the participants, do not be shy. I know Ken and Chris are willing to take them.
Maybe while we are waiting, I do have another question about the geographic locations. I mean, have you noticed any shifts in the geographic locations or ecosystems where the startups are finding funding opportunities. I mean, for the last maybe decade, Silicon Valley is super, active in this area. I know that Ken, you are located in Los Angeles. Is there any shifts in geographic locations that you can point out or not?
The one I have seen is from Qatar. I actually moved that slide basically, but because of the nature of the market right now, I would say 52% of the deals according to Qatar is done in California and New York, compared to the other states, and that because those states tend to have more, they call it legacy, but more robust VC ecosystem than the rest of the markets. But hopefully that will change as we go back to a healthier environment.
Yeah, it'll be interesting to see, particularly in the context of deep tech. So, for example, two factors may favor deep companies having maybe a broader geographical dispersion. The first of which is technology that's getting spun off by colleges and universities, right? And so any college or university that has a very good engineering program, specifically in the area of space or deep tech, one may expect that companies will start to cluster around those colleges or universities if they have a good tech transfer program, and that's not unique to the coast. It could happen in the rest of the United States as well. I think the second of which is in terms of being able to build facilities. If to be able to build product at scale, California can be a pretty expensive place to build manufacturing. So there may be opportunities as companies start to scale to have facilities outside of the coast, and whether or not that also means that the headquarters move is a TBD. But we can see that in the press where some very large companies have decided to move their headquarters outside of California, citing the cost of just the higher cost of being able to manufacture for example, in California.
Yeah, I would agree. I don't think you necessarily need to be in those states to raise money, especially in the kind of post-Zoom era right now. You can raise from anywhere you're based in. It probably makes sense to align in terms of where you can find the talent to help you build a company, and also the customers, right? So I have an electric motor company that's based in Denver because that's where all the aviation, aerospace, talent and also the customers are based in. And and obviously there's certain states maybe they're able to throw in some kind of tax incentive for you to move to their cities, and you want to do those trade-off, make sure that aligns with your business goals.
We did get a question come in from the audience from Tuan Duong. I hope I'm pronouncing that name correctly. Tuan says, this could go to Chris or Ken, either of you. I have a startup and a few government contracts and 6 patents, including 3 pending patents. I'm looking to get a Series A. Do I need to have a company valuation before having a serious talk with VCs?
I can answer that. The valuations is negotiated between you and the lead VC. That's how those numbers get dictated. It's a price that makes sense for both parties, as opposed to an early seed round. Pre-seed tends to be safe, where you set the price and that you think can clear and get the funding that you need.
Anything to add, Ken? Like, it's not something for them to decide to do the valuation. They have to work with the lead investor to identify the valuation number during the Series A.
Yeah, it's effectively a bid and ask, right? And so the company could try to get third-party validation of what they think the valuation is, but at the end of the day, it's going to be up to the investor, the lead investor, as Chris mentioned, to set the valuation. And usually it's not. Usually it's going to be more a function of what other investors who are coming to the table with competing bids, and that's going to kind of set the range for valuation, not an internal valuation.
Thanks so much. Any other questions? If not, yeah. Yeah. I mean, I'd like to get your closing thoughts and final recommendations. And I'd like to thank both of you. Chris, any closing thoughts and final recommendations to the founders?
Yeah, I would say the key takeaway is, the market's slowly improving, but I don't expect any risk on until summer at the earliest. Look at the Fed to guide you in terms of what's going to happen. For any kind of company that have raised during the bull market, and in terms of the next round, you can, think about maybe, wait for the market to go back to equilibrium where it's a little bit more, founders friendly, but you have to do a trade-off in terms of wait till next year to raise expansion or scale. For the other companies that kind of in between, you raise in the seed, but you're not sure whether, what to do next in terms of getting to the price round. So it really depends on, survival, are you in default alive or default survival? Capital efficiency, managing burn properly is the key, because the fundraising process is going to be very prolonged. So you need to have like plan B and C, basically, and going to get more scrutiny in terms of unit economics, margin, profitability, and not just growth. For any kind of early stage startup company, I would say that, it's all pretty much very narrative based. You want to show, not tell. De-risk, show the investors you know how to de-risk the business, show them traction, retention, key contracts. That will help you, better in your fundraising process.
Thanks so much, Chris. And over to you, Ken.
Yeah, agreed with Chris. I mean, I think that, just in today's environment in general, funding will take longer than anticipated. And so from an internal planning process, just have, kind of plan A, B, and C. Markets may change, they may not. And so capital efficiency, I think over the next couple of quarters will be very helpful. And then to the extent possible, identifying non-dilutive financing, grants, having good discussions with customers on what they're looking for. I think, and trying to convert them to either betas to revenue, will be very helpful.
Sounds good. So that's all we have for today. Thanks so much, Ken, and thanks, Chris, for joining us. And I'd like to thank to our audience. We will be sharing the recording with our audience, right, Zach?
Yes.
Okay. So yeah, thank you, and have a good one.
Thanks for the opportunity.